Let's examine a critical risk in hotel development that often goes unnoticed: overstated financial expectations. At the concept stage, it is easy to build a narrative around high occupancy, premium room rates, and strong profitability. These projections make a project look financially attractive, but if they are not anchored in actual market behavior, they create a fragile foundation. From the outset, hotels operate in dynamic environments influenced by demand cycles, competition, and evolving traveler behavior. Performance does not peak immediately after opening. There is always a stabilization period where awareness builds, distribution channels strengthen, and operations mature. When projections ignore this reality and assume near-optimal performance early on, they create a gap between expectation and actual delivery. This gap becomes more pronounced in financed projects. Capital structures are typically aligned with projected cash flows, which determine repayment capacity and financial planning. If those projections are aggressive, they establish repayment expectations that may not align with initial operating performance. Once the hotel begins operations, revenue shortfalls can emerge quickly if market absorption is slower than anticipated. At the same time, cost structures tend to move in the opposite direction. Development costs may escalate due to delays or specification changes. Operating expenses often exceed initial estimates as teams adapt to real-time challenges. External factors such as interest rate fluctuations can further increase financial pressure. Despite these variables, financial obligations remain constant, creating a tightening margin between income and expenditure. As this pressure builds, decision-making often becomes reactive. Pricing strategies shift toward discounting to drive occupancy, which can dilute positioning. Cost controls may be implemented in ways that impact service delivery. Instead of executing a planned strategy, the hotel operates in a cycle of adjustment, attempting to align reality with projections that were never achievable. The root issue lies in how the initial assumptions were constructed. When projections are designed to present the most favorable outcome, they eliminate the buffer required to absorb uncertainty. A hotel project, by nature, requires flexibility, both in financial planning and operational execution. Without that flexibility, even minor deviations from projected performance can have significant financial implications. A more resilient approach is to structure projections around validated data and realistic timelines. This includes understanding true market demand, aligning room rates with actual competitive positioning, and incorporating phased ramp-up scenarios. It also involves building cost assumptions that reflect potential escalations rather than ideal conditions. Equally important is scenario analysis. A well-prepared feasibility model should evaluate how the project performs under varying conditions: slower demand growth, higher operating costs, or changes. In financing terms, the objective is not to prove maximum profitability, but to ensure that the project remains sustainable across different operating environments. In hospitality development, the strength of a project is defined not by how it performs in ideal conditions, but by how it withstands variability. Financial projections should therefore act as a risk management tool, not a sales document. They should guide decision-making with clarity, not create expectations that cannot be met. Ultimately, once the asset is operational, the market determines performance, not the spreadsheet. A disciplined, reality-based approach to projections ensures that the project is positioned to adapt, stabilize, and grow over time. Because in hotel development, long-term success is not driven by optimistic assumptions, but by the ability to deliver consistent results under real-world conditions.